Hey, I got a stock tip for you.
Oh yeah, what's that?
It's gonna make you rich. It's gonna go to the moon. It'll never go down.
Please tell me, what is it?
The ticker is SHIT.
What is going on, guys? Welcome back to the Clover Trading YouTube channel. My name is Kyle Williams. Sorry for that silly little intro, but I hope you get the joke here that if you're in penny stocks, if you're looking for the next hot stock tip, most of these tickers that we're going to talk about, 99.99% of them are going to be like the ticker I just spelled out, SHIT. Okay, so this video is going to be all about what are the pitfalls of penny stocks, what you should be looking out for and being aware of, right? It's great to trade them. There's a lot of advantages. Clearly, I'm an example of that, making, $5+ million over the last 8 years, but it hasn't come with downsides and being aware of pitfalls that exist. And if you are aware of them, you actually can take advantage of them. Okay, so let's talk about that. That's what this video is going to be all about. Make sure to like and subscribe, and let's jump right in. So number one is assume 99.9% of these companies are going to fail. Instead of like the court system where you are innocent and proven guilty, switch that around for these. Be guilty until proven innocent with these. And what I mean by that is no matter what you're trading, do not fall in love with them. Do not think they're the next Amazon, Apple, Google. Understand that 89% of these businesses fail within 5 years, and you're going to see that in the chart. So let's just go over some brief examples. Any one of these tickers are tickers that I have traded in the past or at least put on my watch list. And I just want you to see a trend here. Okay. The first one is Annie. All right, top left to bottom right, right? It was never worth thousands of points or dollars a share. We'll actually talk about it later in this video. But as you can see here, as I scroll down, it just constantly goes top left to bottom right. Okay, so anyone who holds the stock for longer than, a year, 2 years, they're definitely not making money. They are down. Okay, let's look at another one. Let's look at something like CYTO. Okay, this was on my watch list earlier. Okay, what are you in? Top left to bottom right. Again, it was never at thousands of dollars a share. They did reverse splits, which we'll talk about in a second or in a bit. But again, you just scroll down. Anyone who holds over a year or two, thinking they're the next Amazon, Apple, Google, you're likely down in your money. Okay, let's just keep it going just to show you how many there actually are. And again, I'm only going to name a few. There are hundreds and thousands of these things. Okay, let's look at something like RDHL. Okay, again, also my watch list. Again, it has runs. This is when we want to trade them, when it has volatile runs. But after that, you want to leave it alone. Look at this. I mean, seriously, top left to bottom right. And you just go further and it goes further down and down and down and down. So again, once again, anyone who owns these puppies, 1, 2, 3 years thinking they're the next get rich quick hot lottery ticket, you will be severely disappointed. Let's do a couple more just to really cement it in. FEMY. This was a popular one a year or two back. Actually, this one isn't bad. This one's a fairly new stock. It's only been around since 2021. But even then, right, was trading up at around $11, is now down to 1. Down 90% off its highs. Let's look at one more. AMC. AMC, yes, has a lot of huge runs. Had a huge one back around in 2021, but even off of those highs, it was trading at once what, pre-reverse split is $700. It is now trading, if we zoom in, we just keep going down, it is trading at 4. So down 99% off those highs. Again, top left to bottom right. You just don't want to be committed to these things, right? Use them to your advantage. Trade them like they are, which are just tickers, and move on. Okay. The second pitfall, and this gets a little bit into deeper of why all these stocks look this way, right? Why is it that 90% of these penny stocks look like this, where they are top left to bottom right? There's a main reason for that. One is these companies don't make money, right? They are newer businesses. They're trying to make it happen. It's not like all these companies are trying to fail. They're trying to succeed. The reality is though, just so many, business is hard, right? Business is difficult. And most of these businesses will not make a profit. And if they do, it's very short-lived, right? It's a very harsh period and just time for these companies to succeed in general. Like, doesn't matter. I'm not talking about the time it is in 2024. Just starting a newer business is difficult, okay? Now, if they don't make money, where do they pay for things? They either go into debt, which is a factor here, or you have to ask yourselves, why are they a stock in the first place? When you become a stock, you can sell shares. And when you sell shares, you get money for that. That's how some of these companies have survived. Right, so we're going to go into some examples how there is what I would call like the dilution spiral of death that causes some of these companies to go from top left and then be down 99.9% off their highs because they're using dilution to keep their company alive, can have their company even receive cash anywhere to pay for things, to pay for expenses because they're not making a profit off it. Right, and so what is dilution for someone who doesn't know what that is or has never heard that term before? Let's say there is a supercar. Okay, and there's 100 of them. Okay, and if you're one of those 100 owners of that supercar, you feel pretty valuable. right? You own one of these top elite 100 supercars. But all of a sudden, the car company that made those cars says, yeah, you know what? We're going to make 1,000 more of them. Now you're not one of 100, you're one of 1,000. That's kind of what these companies do with their shares. Let's say a company has 1,000, not 1,000, let's just say a company has 1 million shares outstanding and you own 100 of them. You know, you own 100 shares of a company that only can have 1 million available. That's somewhat rare. That feels kind of special, right? What if the company comes out and says, yeah, you know what? We have 1 million, but we need cash to survive. So we're going to sell into the public market 5 million more shares. Yeah, you still own 100 shares, but now there's 6 million instead of 1 million. The percentage you own of the company gets diluted massively. Instead of owning, let's say 1% of a company, you now own 0.25% or a fraction of a percent, even less. Like the amount you own goes down drastically. And that reflects in the stock price, right? You may think you own the same amount of shares at a certain price, but once this company sells you those amount of shares and the market cap doesn't change, because again, they're not profitable, they're not growing, the share price goes down, and then so does your investment. And so something like AMC here was never trading at $700 a share up here, right? They were once trading at $70 a share, but they kept selling then more shares into the open market and brought the stock down so low that they said, you know what, we need to reverse split our stock. Meaning, if the stock is trading for $1 and they want their stock price higher, they will then say, hey, we're going to do 10 for 1. Our stock's going to go from $1 to 10, but the amount of shares that you own are going to get divided by 10. The company stays the same, the market cap stays the same, but the stock price is going to go up. So you're going to own less shares. There's going to be less shares available, which sounds like a good thing, right? It's almost a reverse of dilution in a way, where say that company that I use that example went from 1 million to 5 million shares. If they do a 5-for-1 reverse split, well, now their company shares go from 5 million back to 1 million. But you have to understand, a lot of companies do that to then sell more shares again, rinse, repeat over and over and over again. So yes, AMC did a 10-for-1 reverse split. So when you look back, it wasn't trading at 700, it was actually trading at 70, but they did that so they can sell more shares, right? They've diluted this company down over and over and over again. And now their shares are in the hundreds of millions. Right, there's not a few million or it's got diluted down drastically. Let's look at something else like NKLA. Right, NKLA was a very hot, popular EV company. It was very hot when it opened. Again, it's saying the stock price was once 2,700. It was never that much. I think it was maybe 80 or 90. Right, what they do? Reverse split, dilution. Sell more shares to get cash to keep the company alive. Because again, they don't make a profit. Right, same thing here. Mullen's another EV company that wants to be successful, right? The saddest part about all this is that if we zoom in, it's now at 20 cents? Let's just go back. It says it was trading at $300,000 a share. It was never trading that much, guys. This company has done numerous reversals, not one, like 2 or 3 or 4, honestly. And again, they just keep diluting, unfortunately, because they don't make a profit. Okay. And so that is what I mean. That is why you usually will see so many companies like this go from top left to bottom right, because there's a mechanism in the background that is causing this cycle to happen. Okay. And it's legal. It's not illegal. Dozens of hundreds of thousands of companies do this. It's just part of the game. And so as a trader, you need to be aware of that. That is the pitfall. Now, yes, you're looking at this and you're seeing it happen. Well, this happens over multiple years, Kyle. I shouldn't have to worry about any one day or hour or week. Right? This happens a much slower process is what you're showing me. This happens over years. I shouldn't be worried about that. You'd be wrong.
Ever dreamed of trading like one of the Clovers? Well, it all starts with the right broker. Clover Trading and Centerpoint Securities have teamed up to supercharge your trading experience. By joining Unlock the Power of CP Edge exclusively with Centerpoint. We're talking top-tier trading tools worth over $6,000, all at your fingertips. Get ahead with real-time scanners, cutting-edge news, and a tailor-made trading journal. Experience trading like never before with superior short inventory, personalized support, and interest on your idle funds. Plus, you can get competitive pricing that fits your trading style. Ready to elevate your trading game? Click the Clover Trading link in the description below to get exclusive deals with Centerpoint Securities. Now let's get back to the content.
Let's look at something like VRAX. Okay, when the dilution happens and it comes to the open market, it happens immediately. The effect, though, is the long term, right? But when it happens, it can happen immediately. And if you're long a stock, it's going to affect you to lose, right? VRAX is a perfect example of that. If we go back, again, same thing, top left to bottom right, it was never at $200 a share. Now it's trading around $3 or $4 a share. I took this stock long overnight on August 21st here. This big green candle, I took it long overnight, okay? And the next day, it actually gapped down. Yes, it spiked a little bit, but it actually failed and went lower. Why was that? They did an offering. An offering is a form of dilution. An offering is a form of the company saying, hey, we have 1 million shares outstanding, back to that example, and we're going to sell 4 million more to get to 5 million, okay? That is literally what the offering is, and that's a perfect example of why I lost money on this trade. I took it long overnight. I bought it in after hours. I bought it like low 6s in after hours. It's continued to uptrend. It closed at 750. I was up on my position thinking it's going to go higher the next night. Once after hours closed, they put out an offering. They said, hey, we need cash. We're going to sell shares into the open market. So next day in pre-market, it collapses from 450 all the way down to 5. You know, an entire 30% haircut from 750 to 5 in literally what looks like, 2 minutes, 3 minutes. Okay. Again, and if I'm long from low 6s, I'm immediately down. And yes, I lost money on this trade. I lost like $9,000 on this trade. Now, granted, I'm a profitable trader. I can afford to lose $9,000. My accounts are much bigger. It's a no big deal. It's a small average loss for me, right? But if you're a newer beginning trader and you only have $5,000 in your account and you take, say, a fairly large position, because again, sometimes small accounts have to do that to grow, you just lost 30% of your money, right? That's a big hindrance to you finding profitability. Now, granted, I'm not saying you're not gonna, you can avoid this. Eventually, if you trade long enough, you will be caught in an offering. It's almost like a writing of passage if you trade penny stocks. But knowing that they exist and trying to figure out and get good at what companies are more likely to do it than others, you can get pretty good at avoiding these pitfalls. For me, unfortunately, this is one I actually couldn't avoid and got caught in, and it's pretty rare. This is like one of maybe a handful of offerings I've been caught in. So it doesn't happen often, but it can happen. Okay, so it's something to be aware of and something to be just watchful for, right? This is the pitfalls of penny stocks. These are the things you need to, that come with the volatility. Like, yes, these companies are going to go up hundreds of percent. Again, we're looking at VRAX here. It went from $1 or $2 all the way to as high as 9. That's an awesome percent gain. If you were long that, that's awesome. That's called lots of money in your account, right? But if you're timing it incorrectly, when they do an offering, it's a different story. And the last thing I want to mention here, and has to do with the volatility, because there are tickers like VRAX that can go from $1 to 9, or tickers that like BOF recently that can go from 70 cents to $4, right? This volatility is awesome. This is why I personally gravitate and like trading penny stocks, because I love seeing tickers go up 20, 30, 50, 100% a day. With that being said, I think a lot of traders also think that because trading is trading and you want to make more money and people are greedy, that you have to use leverage. I don't think I've ever used leverage in my entire career when it comes to penny stocks. At least not crazy multiples where it's like I'm trading 5 to 1, 10 to 1, something ridiculous, right? Because it's not needed, right? I'm not trading Forex where these foreign exchanges, or sorry, these currencies are trading a fraction of a percent a day and you need to leverage up 100 to 1 to make something out of it, right? I'm trading a stock that's going up 100% a day. And so I only need to take a 10, 20, 30 grand dollar position to have it go up 50%, and I make 50 or 15 grand, 10 grand, 5 grand, whatever it may be. So going in, understand you don't need as much money as you think, right? You don't need to leverage in 10 to 1 to make something happen. In fact, that's the quickest way to blow up, because vice versa, what if you're 10 to 1 overnight on VRAX, like I said, and you get offered on, and instead of losing 30%, you lose your entire account and you get margin called. So understand that you want to use the volatility to your advantage, and in doing so means you don't need to max leverage up to be profitable. Like I said, I've made over $5 million over the last 8 years, never have used leverage consistently. In fact, if I've used leverage, it's been on accident that I didn't even realize. And it probably was something like less than 2 to 1. It's never been multiples of my account, right? And so you just don't need it. It does need to be taking place. And over the long run, I think it keeps you safer more than not. So anyways, guys, thanks so much for watching. Again, I don't want to, fear monger anyone into not trading penny stocks. Again, I am an example of it works. So is Dom, so is Huddy, so is a lot of our students that are actually making money and being profitable. And so I don't mean to discourage you. It's just learning the pitfalls and learning how to avoid them, and then also learning how to use them to your advantage is what's going to get you on the right side of the ball to being profitable long term. So anyways, like and subscribe. Thanks so much, guys. Write in the comments below if you think there's any pitfalls I missed. There's plenty of very unique examples per company. It's not just the broad overall market that I kind of went over in this video. Maybe you have some horror stories to share. If you're willing to share, we'd love to hear them and just be there for you, so to speak. So anyways, guys, thanks so much for watching. I'll see you guys in the next video, and peace out. Bye.